Welcome to Japan Market Brief, the daily English audio update on what moved Japan's markets and what matters next. April 9th was the second straight strong rebound day for Tokyo. Japan's Nikkei 225 rose 4.81% to 55,997.18. On the surface, that looked like a convincing continuation of risk appetite. And in the short term, it was. But the structure of the move still matters. This was not a session driven by suddenly strong domestic growth. It was a market still benefiting from the unwind of the oil and geopolitical stress that had dominated the prior stretch of trading. The first support came from the same direction as yesterday. Oil remained much lower than the panic highs, which helped ease the import cost pressure story that had weighed heavily on Japan. The second support came from abroad. The S&P 500 rose another 2.51%, and the US 10-year yield moved lower. That is a useful combination for Japan because it supports sentiment without immediately adding new dollar-yen pressure. Dollar-yen itself stayed relatively calm, around 158.7. That calm matters. It meant the Japanese market did not have to digest another round of sharp currency stress on top of everything else. So the market had enough room to keep rallying. But under that surface, the domestic signal still looked weak. There was no single fresh Bank of Japan headline that reset the market. Instead, the more important point was that the currency and rates backdrop did not get worse. The market could continue leaning on the relief trade because it was not being interrupted by a new yen shock or a new oil shock. That does not mean the domestic macro problem has been solved. It only means the external pressure eased enough for equities to extend the rebound. That distinction matters because domestic indicators still look poor. NHK reported that the March Economy Watchers survey fell to its lowest level since the early phase of the Ukraine war shock. That is a useful real economy signal because it reflects how people closer to day-to-day activity are seeing conditions on the ground. There was also another warning sign. Corporate bankruptcies in the last fiscal year moved above 10,000 cases. That tells you stress is still spreading in parts of the business environment, even while equities are recovering. So today's market move was still stronger than the domestic backdrop would normally justify on its own. It remained a relief extension more than a clean domestic reacceleration story. Today's stock to watch is Ministop. NHK reported that the convenience store chain posted a net loss of about 5.6 billion yen for the year through February after the expiration label fraud issue. Coverage of the results also indicated that by the end of February, only about 772 stores had resumed the suspended in-store food sales, around 40% of the network. That is why the stock is useful today. It combines two pressures at once. One is weak consumer demand. The other is damaged trust. When household spending is already soft, a retailer recovering from a compliance problem has less margin for error. Traffic can stay weak for longer, margin recovery can slow down, and investors can become far more selective about which consumer names deserve patience. So Ministop is not just an earnings story. It is a read on how the Japanese market is pricing turnaround risk in a fragile consumer environment. For the next session, three things matter most. First, whether oil stays contained and keeps pressure off Japan's import cost story. Second, whether dollar-yen remains stable rather than drifting back into a more stressed range. Third, whether more domestic indicators keep pointing to weak demand and tougher operating conditions, even if equities continue to hold up. If Tokyo stays strong, while those domestic warning signs remain in place, the market will look increasingly like a relief trade, sitting on top of an economy that still has not regained convincing momentum. That is all for today's Japan Market Brief. Thanks for listening.